After soaring almost 200% from its November 2022 lows, did we lost the Meta train? The current PE ratio of 31.31x doesn't indicate a severe overvaluation, but the price-to-free cash flow ratio stands at an insanely high 130.15x. What will the dude do? We'll be taking a look at some juicy details, so stay tuned with the Finance Dude. Hey dudes and duderinas, this is the Finance Dude. Welcome to one of the most complete and exhaustive stock analysis on YouTube. Since this is a new channel, you can watch how my stock picking strategy works in full detail by clicking on the videos on the top right. In this episode, we have two missions. First, assess whether Meta is a good business and has what it takes to move on to Analysis 2.0, and second, assess Meta's valuation. Now sit back, relax, get ready for some top-notch financial analysis, and let's make finance fun. As always, I start this first approach with the 5 dimensions method, where I base my analysis on 5 different pillars: growth, profitability, solvency, valuation, and dividends. I won't bore you with every single metric in detail, but in the end, I'll show you the full table with the ratings. First up, we've got the first dimension, growth. And let me tell you, Meta's revenue growth is insane. In just 10 years, their revenue skyrocketed from $7 billion to a staggering $117 billion. If we exclude the year 2022 and the most recent 12 months of revenue, Meta's revenue has been growing at an incredible rate of 40% per year. This adds up to a total growth of 1,390% in 10 years. Wow. Needless to say, I'm giving them a rating of 5. This is definitely a strong start. Moving on to net income growth, we can't ignore the significant decline of almost 50% in 2022. That's definitely a cause for concern. However, when we consider the average growth rate over the past 10 years, Meta's profits have been growing at a rate exceeding 30%. So, should we be disappointed with a 30% yearly growth rate? Absolutely not. It's important to understand that this decline was primarily influenced by Meta's investment in the metaverse, which resulted in higher operational costs, including R&D, as well as selling, general, and administrative expenses. This impact was reflected in the sharp decline of Meta's stock. However, the good news is that CEO Mark Zuckerberg has already started reducing expenses, and guess what? The markets loved it. This led to an impressive stock price increase of almost 200%. Moreover, Meta's profits grew by a whopping 1,338.2% in total. Without a doubt, I give them a rating of 5 for net income growth. Now, let's take a look at Meta's free cash flow growth. Despite a similar pattern in the graph, there is a considerable difference between net income growth and free cash flow growth. While net income has averaged a growth rate of 30% over the past decade, free cash flow growth has been only 10% per year. Net income experienced a remarkable growth of 1,338.2%, whereas free cash flows grew by only 164% over the same period of 10 years. Additionally, what concerns me more is the fact that net income stands at $21 billion, while free cash flows are only $5 billion. This discrepancy raised some questions. Typically, we expect net income and free cash flows to align closely. What could be happening here? If Meta moves on to Analysis 2.0, I will dive deep into this topic. As investors, we want to see profits backed by strong cash flows. Ultimately, what truly matters is the cash a business generates, not just accounting profits. Rest assured, if Meta progresses to Analysis 2.0, I will thoroughly investigate this matter. Finally, it's important to note that free cash flows experienced a significant decline of 83% from their peak of nearly $30 billion in 2021. While I believe there is potential for these free cash flows to rebound to previous levels, this decline is somewhat concerning. Considering all of these factors, I give Meta a rating of 2 for free cash flow growth. Moving on to the second dimension, profitability. What we see in this dimension is a free fall in profitability across all metrics. See gross, operating, net income, and free cash flow margins. All are at or below their historical lows. And in free cash flow margin, we see a measly margin of 4.4%. This is from a business that already had this margin around 30%. Scaring. Given this, I'll give all of them a rating of 1. On a positive note, despite the current ROIC being lower than the 5 and 10-year averages, the current value of 20.8% is still impressive. Therefore, I will give it a rating of 3. It's evident that profitability doesn't look favorable for Meta at the moment. However, it's worth mentioning that some specialists believe that if you press the like button on this video and subscribe to this channel, there might be a butterfly effect that could help Meta's profits soar. Moving on to the third dimension, solvency. First, let's discuss the quick ratio. Although Meta's quick ratio has decreased over the analysis period, a quick ratio of 2.07 is still considered excellent. Typically, it only raises concerns when this ratio falls below 1, depending on the industry. So, in this case, the quick ratio is rock solid, earning a rating of 5. Next, let's look at the debt-to-equity ratio. Yeah, debt increased a lot when compared to Meta's equity. However, a debt-to-equity ratio of 0.22 is still solid as a rock. No worries at all in this. Rating of 5. The following ratio to analyze is net debt to EBITDA. Yup, Meta has more cash than debt. Rating of 5. Lastly, debt to free cash flow. As we can see, not everything is a bed of roses in this solvency dimension. The current ratio of 5.35 is too high, indicating that with the current level of free cash flows generated each year, it would take more than 5 years to pay off all of Meta's debt. Ideally, we want this ratio to be below 5. However, as we mentioned earlier, the significant decline in free cash flows was due to Meta's investments in the metaverse. If Meta moves on to Analysis 2.0, we will conduct a deep analysis of its capex and operating costs. I am willing to bet that these costs have surged in recent years. That's why I'm not overly concerned about this ratio. I believe it's a matter of implementing cost-saving measures to restore the level of free cash flows seen in 2021, which will subsequently bring this ratio back below 1, as it was before the free cash flow crash. Therefore, I assign a rating of 2 to this ratio due to its high value, but with the belief that it can be improved. It's time to move on to the fourth dimension, valuation. Starting with enterprise value to sales ratio. In contrast to most of the businesses I have analyzed thus far, which you can find in the top right, Meta's enterprise value to sales multiple has actually decreased over the 10-year period. This is quite impressive. By the end of 2022, this multiple stood at 2.74x, which is unbelievably low. Currently, the stock has almost tripled from its bottom, but it still remains below any other ratio it had over the last 10 years. This raises the question, is it still a good time to buy Meta? That's exactly what I will try to answer, dudes. This multiple gets a rating of 5. Moving on to the price to free cash flow ratio, we observe that it is currently trading at all-time highs. However, there's a clear reason behind this, my friends. It's a result of the crash in Meta's free cash flows. This is an anomaly that I believe will soon be resolved, and Meta will return to its previous levels of significant cash flow generation. If that were to happen, we can see that Meta traded at a price to free cash flow multiple ranging between 30 to 40x over a span of 7 years. So, if Meta were to regain its previous all-time high free cash flow of nearly $30 billion, at a midpoint multiple of 35x, it should trade at around $1.05 trillion. Considering Meta's current market cap of $664 billion, there would still be room for a 58% increase in its market cap. If the share price increased in a similar proportion, it could reach as high as $393 per share. That's certainly exciting. However, we must remain cautious. There is still plenty to analyze and investigate. Given the all-time high price to free cash flow multiple, I give this metric a rating of 1. Moving on to the PE ratio, we see a different trend compared to the price to free cash flow multiple. As we previously discussed in the comparison between net income and free cash flow, I'm intrigued by this disparity. The PE ratio receives a rating of 4 as it is trading below the 10-year average, but above the 5-year average of 24.29x. Finally, we come to the not least important fifth dimension, dividends. Since Meta does not pay a dividend, the metrics dividend growth, dividend yield, and payout ratio naturally receive a rating of 1, as they are not applicable in this case. However, there is still one metric to be analyzed within this dimension, which is the number of shares outstanding. Similar to what we observed in the analysis of Google, Meta diluted its shareholders until 2017. This was understandable, as it was a growing business in need of cash and was not generating the cash flows it does today. However, since then, Meta has started to repurchase its outstanding shares at a rate of 1.8% per year, which is praiseworthy. In 2022 alone, Meta bought back 5.5% of its outstanding shares, amounting to more than 150 million shares. While we certainly expect this trend to continue, it is important to note that the current outstanding shares still remain significantly higher than they were 10 years ago. Taking this into consideration, a rating of 3 is appropriate for this metric. Now, it's time for the summary table with every 5D component. Having concluded this 5-dimension section, we arrived at final rating of 3.05, which is great. But this isn't it. We still have lots of work ahead of us, and this is just one data point in this investment process. But before we get to the juicy part where we dive into the company's valuation, I need a favor from you. If you're having fun watching this video and learning something new, please show some love and support to the dude by doing these 4 simple things. Subscribe to the channel, smash that like button, ring that bell, and spread the word to your friends. It would help me a lot with this project. Okay dudes, we're ready to rock and roll with this DCF valuation. First, we need to make some assumptions based on what we know from their historical data and recent trends. One negative aspect to consider is the significant decline in Meta's cash flows. Over the course of 2 years, Meta's cash flows have plummeted by 83%, leading to a decline in free cash flow margins to 4.4%. While I don't believe this indicates a new trend, it's important to exercise caution and understand Mark Zuckerberg's plans to bring these values up again. Additionally, revenue growth has slowed down. As we discussed earlier in this analysis, Meta had been averaging a 40% yearly growth in revenue until 2021. However, since then, revenues barely grew. To finalize this negative rant, Meta's price to free cash flow multiple is currently at an extremely high level. However, it's important to note that we expect this to be a temporary situation. Once Meta increases its cash flows, we anticipate that this multiple will return to normal levels. On a positive note, Meta's rate of shares buyback is quite generous, exceeding 1% per year. Now, let's consider the estimates provided by analysts. They project an average revenue growth rate of 9.76% and an average cash flow growth rate of 24.28% over the next 3 years. Enough of talk, you all want to know my assumptions. Starting with cash flow's growth forecast for the first 5 years of the projection, I chose to be more ambitious than Meta analysts' forecasts, with a 33% growth rate. The cash flow growth for years 5 to 10, I chose a lower rate of 25%. I acknowledge that these growth rates may seem extremely high. However, considering the significant decline in Meta's free cash flows, 83%, even with these growth rates, it would take 6 years for Meta to reach the same free cash flow level it had at its peak of around $30 billion in 2021. Moving on to another crucial assumption, shares buyback, dilution. Meta demonstrated a commitment to generous annual rates of share buybacks, and I expect this trend to continue. Therefore, I've chosen a buyback rate of 1.5%. Now let's look at Meta's free cash flow margin. The current value of 4.4% is disappointingly low. However, with the belief that Meta's business will rebound, I anticipate a margin of at least 25% 10 years from now. Finally, let's address the price to free cash flow multiple. Meta's current multiple of 130.2x is notably high, and we've already discussed the reasons behind this. When considering the longer term, it is reasonable to expect that growth will taper off, margins will stabilize, and multiples will adjust accordingly. That's why I've chosen a price to free cash flow multiple of 17.5x. These are the assumptions for the base case. In the subsequent scenarios, I will make adjustments to reflect varying degrees of conservatism or optimism. After running the DCF model for each scenario, I obtained the following results. Starting with the base case, if we believe that the provided assumptions will materialize, the fair value of Meta's stock would be $227.90, a downside of -9.5% from its current price. It suggests that Meta is currently trading around its fair value, which is great. According to these assumptions, Meta is expected to generate $65 billion in yearly cash flows by 2032, which is double the cash flows generated in 2021. I really think that this level of growth is easily achievable. Moving on to the bull case, if we believe that the assumptions for this scenario will come true, the stock could be valued at up to $333.38 in order to have my required rate of return of 12%, representing a 32.4% upside from its current price. This scenario also means that buying the stock at the current price, we would have an internal rate of return of 14.7%, above the required rate of return of 12%. While the probability of this scenario may be lower than that of the base case, I still considered it very plausible. In this scenario, Meta would need to grow its revenues 2.5 times to reach $302 billion, with cash flows of $84.7 billion, almost 3 times the peak cash flows in 2021. Considering the growth rates Meta had over the past decade, this type of growth isn't impossible at all. Bear case is assuming minimal revenue growth, with an average annual growth rate of only 1.61% and cash flows reaching the peak levels we saw in 2021 only in 2032. This is crazy conservative, right? Last year, there was a 2-week window that we could have bought Meta's stock below the $103.07 price target of this scenario. It's crazy. What we are getting here is that Meta was a scream buy. However, with Meta's stock price nearly tripling since its lows in November 2022, it is too late for this scenario, at least for now. Moving now to the extreme cases, let's start with the extreme bull case. This scenario is highly ambitious, assuming $100 billion in free cash flows and $336 billion in revenues 10 years from now. It poses the question of whether Meta can achieve such remarkable results. If this scenario were to materialize, buying the stock at the current price would yield an implied rate of return of 18.3%, an outstanding return. Another thing that it will be outstanding is the return that the dudes who click the like button and subscribe to this channel. In the extreme bear case, everything goes wrong. Meta's bet on the metaverse fails, share buybacks cease, they are unable to reach the 2021 peak of $30 billion in free cash flows over the next 10 years, and their revenues actually decrease. Very poor performance. While it may not be highly likely, it is still a possibility that needs to be considered. In this scenario, the stock price would decrease from the current $251.86 to $106.07 in 10 years. It's important to remember that these assumptions serve as an initial assessment of Meta's valuation and don't consider qualitative information from more advanced analyses like Analysis 2.0. Before making any investment decisions, it's crucial to stress test these assumptions. But for now, I hope this gives you a good idea of where Meta stands in terms of valuation. This is the summary table with all the scenarios' price targets and probabilities. The probabilities that I think best reflect the scenarios I made are 60% for base case, 27.5% for bull case, 10% for bear case, 2% for extreme bull case, and 0.5% for extreme bear case. Considering these probabilities, the final price target for the stock is $247.97, indicating a slight overvaluation of 1.5%. As you can imagine, this is a meaningless difference, and this gap suggests that the stock is fairly valued. Buying at the current price would meet the required rate of return of 12% per year over the next decade. Looking at the graph, you can see that the stock has mostly traded within the blue area in the past year, briefly entering the green area in November 2022. Based on this analysis, we might have missed a great opportunity to buy Meta stock. Currently, the stock is trading within the bull case range, which means we would need more optimistic assumptions to achieve the 12% required rate of return. However, this shouldn't be a cause for concern or a sign that the opportunity is completely lost. As observed, Meta is trading close to its fair price, only about 9% above our base case scenario. It is also trading just 1.5% above the final price target, which is a weighted average of all the scenarios. This suggests that a minor pullback in the stock price could present another favorable opportunity to invest in Meta stock. But before making any investment decisions, it's important to remember that there is still plenty of work to be done. Let's not rush ahead. Now, let's move on to multiple valuation to confirm the results we obtained so far. To determine a fair price for a company, we need to compare its current multiple to the best choice of 5 and 10-year averages. In the case of Meta, there's a clear sign of higher multiples in the 10-year average and more reasonable ones in the 5-year average. That's why I will choose the latter. By averaging all the prices, we arrive at a price per share of $219.54, indicating a downside of minus 12.8%. Let's summarize the analysis of Meta's business by comparing 3 different data points: 5 dimensions, DCF valuation, and multiple valuation. One of our missions for today was to assess whether Meta is a good business and has what it takes to move on to Analysis 2.0. Well, the 5 dimensions revealed that Meta is a great business, earning a final rating of 3.05. It particularly excels in the growth and solvency dimensions. However, it lags in profitability and dividends dimensions. While the focus on reinvesting free cash flows into the business explains the absence of dividends, the results of the profitability metrics such as EBITDA, net income, and free cash flows are concerning. Meta experienced an 83% decline in free cash flows, which is troubling, and I certainly hope it's a temporary setback. Additionally, the difference between net income and free cash flows is also troublesome. Normally, these two should align, but in Meta's case, profits are not fully supported by cash flows. On a positive note, Meta demonstrates a strong return on invested capital above 20% and is actively buying back outstanding shares. Our other mission was to assess Meta's valuation. While DCF indicates a fairly valued business, multiple valuation suggests that Meta is getting a little bit pricey, but nothing too high. A small correction in the stock price would come handy to bring it within our preferred buying range. Taking all this into consideration, my final verdict is that Meta will proceed to the next round, Analysis 2.0. So far, we have seen that Meta is a great business but with a couple of issues that need to be deeply analyzed before making an investment decision. After analyzing severely overvalued businesses like Tesla, Microsoft, and Apple, it's great to find fairly valued businesses like Google and Meta platforms. Don't forget, you have all of these analysis on the top right. Go have a look. If you can't wait for this second analysis, don't forget to subscribe to the channel and turn the bell on so you receive the notification once I post the video. Thanks for watching, and I'd love to hear your thoughts on Meta's business. And what are the next stocks you would like to be analyzed here? Leave a comment below and let me know what you think. Peace, dudes. You rock.